All right, guys, welcome to another episode of Wisdom and Wealth. I got something that I want to talk to you guys about today. Today's title of this message is How to Avoid Screwing Up an Inheritance. And so we are in the middle of this huge wealth transfer right now. And so there is a lot of people receiving wealth over the next 20, 30 years. And that's going to be surviving spouses, it's going to be children, it's going to be grandchildren. And there's a lot of things that could get screwed up in this way. And I want to talk to you guys about how to avoid that. And there's a lot of awesome things and blessings that are coming down the pipe. And so we just want to talk about that a little bit. And so I'm going to start off with a story of why. And so we have somebody, an advisor in our office right now that had a close friend. And this person was in the music industry, and they actually lost 5 million of their inheritance to a wrong person. And what happened in that situation in this musician's life essentially was that the titling of those accounts were incorrect. And when they went to court to go battle this inheritance problem, they lost. And so 5 million in inheritance was gone from this specific scenario. And you could imagine how they felt in this situation. They're supposed to get this from their parents. This is a legacy to be left, right? If you have the right heart about what money is just a representation of your life's work, your blood, sweat, and tears. And so this is like losing a family heirloom or getting stolen from you potentially. And so there's a lot of emotions that go into it. And so you don't want to be caught in that situation, especially if that money was meant to go to you. And so we want to help prevent some of those things. And so let's talk about it. And I'm going to talk about where we're going to be covering basically the 3 biggest ways inheritances get screwed up and some fixes on how we can go look at that. Now, I can't give you guys direct financial advice on this, okay? I don't know your specific scenario. I don't know the asset breakup or the balance sheet or what it looks like. So none of this is direct advice to any specific person, but I want to talk about some tools that we can use in those situations to circumvent some of these issues, okay? So let's talk about a couple stats first, though. So this is interesting. We've talked about this a lot, and I'm actually putting this in something exciting that I'm going to tell you about later on that I'm working on. It's a special project we're planning on coming out in Q1 26. I'll announce later, but I'm going to talk about this in some of this material. 70% of wealth is lost in the second generation, and 90% of wealth is lost in the third. And only 40% of that wealth lost is attributed to investments. So what does that mean? That means that kids squander it, or it gets disinherited somehow, which isn't really tracked, by the way, in these numbers, or just has a find a way. People just have a way of money finds a way of disappearing if you don't manage it meticulously. And so, but 84 trillion in wealth is expected to transfer by 2045. 84 trillion. 53 trillion of that is going to go to heirs, mainly Gen X and Millennials. And so here's the problem with that. Only a third of that wealth, of the families that make up that wealth, actually have a plan in place for that to transfer to their people, to their heirs, or to the people that they want it to go to. And so that means you have two-thirds of $84 trillion that has no plan and might be subject to the wrong people. So this is a big problem. So if you're in this camp, you really need to listen if you have any concern at all. And so let's jump into it. So this is the 3 biggest threats to an inheritance, okay? Whether you're leaving one to your babies or you're receiving one. And so and I'll caveat this too, because we've had a lot of conversations where somebody's leaving an inheritance and they just assume the money's going to go to their kids, or just kind of assume it goes where they want it. I guess it'll kind of go there. And they're kind of really lackadaisical about it. And I'm going to encourage you to not be lackadaisical. You need to be intentional about this, because lackadaisical, if you go with the flow, water flows one way, that's downhill. And I don't know about you, but I want to go uphill. And so I don't want anything going downhill, going to the wrong places at all. And so let's talk about this. If number one problem, or one of the biggest threats to an inheritance, is probate, or poor titling in your assets. And what I mean by that is, if assets are titled into your personal name, they have a chance to go to probate. Now, there's a lot of caveats to this and different types of money and different types of assets that make this up. Okay. But if assets are subject to probate or go through intestate or intestacy, if you've ever heard of this, it has two main problems with it. One, it's public knowledge. So anybody and their mom can go look up and see what you left and who you left it to. And I don't know about you, but I don't really have, I've lived a public enough life up to this point already. I don't really care anybody knowing what I'm leaving to my family when I'm gone. Family or non-family. Okay. There's a lot of people, the hands come out. They just have a way of coming out when somebody dies. And we got stories for days. They're like, hey, your mom promised me this, or your grandma promised me the land, or promised me 10 grand. And the stories just are really wild. And so if you get somebody really humming, you need to go listen to your grandparents if they've ever gone through losing somebody and getting in their own inheritance and how many people came with their hand out. And so it's pretty wild. Okay. But it's public knowledge. So there's actually this is a whole black market where a bunch of guys, they go prey on especially widows because women live longer than men. And so you ever heard of like your grandma or somebody passing away, losing their husband, and they get bombarded with sales calls? This is why. It's because they just went on a list, all their assets, and say, hey, I just saw you inherited 5 million, 10 million bucks. Let me help you spend that. That's basically the attitude that goes up. It's crazy. Okay. I don't want you guys to be subject to that. I want private knowledge. I don't want public knowledge of my asset. The second problem with that is it's contestable. What does that mean? It means that if there's somebody close enough to your situation, and every state is a little different, okay? But if there's somebody close enough to your situation, they can file contest with the court. By law, the judge has to open it up, which can prolong it from 1 to 3+ years. And so what that means is those assets or that inheritance, wherever it's pegged to go, is tied up for that time. So any benefit to any beneficiaries, maybe to the babies or to the kids, they have no access to those resources. Okay. And then on top of it, probate cost is usually a percentage of the estate. So that gets reduced. It comes out of the estate. And there's about, I want to say is about $2 billion a year that gets lost in probate cost and attorney fees alone. Okay. So there's a lot that gets eaten out of probate. And then let's just say if by law, the judge had to open up that contest, whoever filed that, who's close, and then he has to go through the proceedings to basically determine whether they have a case or not. And if they do have a case and he sees it, even if you have a will is merely instruction for probate. Okay. It's a good first step, but it's an instruction for probate. But even if you have a will and he sees it, they provide a sound enough case that they should receive some or all assets, the judge can redirect those assets. And so case in point, I had a buddy I actually played ball with back in the day. He said that happened to my aunt or my mom. I can't remember. He said it was his dad. And he goes, my dad, that's what it was. His aunt had willed his dad the house, and the brother, when the aunt passed away, the brother of the three of them came and contested the will, and the judge redirected her house to the brother. And so really wild, but this is a major issue as it comes to inheritance. Okay. So we want to prevent those issues from coming in. So we really got to pay attention to this stuff. Probate, I say probate and poor titling. Titling supersedes all wills or trusts. And so what I mean by that is we'll have people come in here and they'll be like, man, my family, they've done really well. Maybe I'm an only child, so there's not a lot of contestability to worry about. Or, so I don't have a whole lot to worry about. They've done a ton of planning. We really start diving into questions. Well, way over 90% of the time, trusts aren't funded. What does that mean? That means I got a Corvette sitting in the garage, not doing what it's supposed to do. I got a ship in the harbor, not at sea, sailing what it's supposed to be doing. And so it's basically, it can be rendered useless at times if titling of assets are incorrect. And so this ends up being a real deal. And I'll give you a real life example is we had a couple come in at one time, second marriage, kids from previous marriage, had a joint with rights of survivorship account and came in, doesn't matter what their will says at that time at all. And so immediately they started sharing their story with me. And I go, okay, so who's disinheriting one side of the kids? Which side of the kids? And they both kind of looked at me befuddled, and they were like, well, what are you talking about? Why would you say something like that? And I go, well, I'm not passing judgment. I'm just asking, was that part of the plan? And they're like, well, what are you talking about? I go, well, as it stands right now, all right, if you die, it all passes to him, and he can cut out your kids if he wants to, or vice versa. He dies, it all passes to you, and he can cut out your kids. Or if you really want to go down the grand path, that happens. He gets remarried, he dies, it all goes to the next spouse, and they can cut out both sides of the kids altogether. And so you can really go through crazy stuff here, but it doesn't matter what his will or trust or their will or trust said at the time. Titling supersedes assets. This is one of the biggest issues we see in inheritance planning, okay, or in succession planning. So probate and poor titling. Number 2, taxes and hidden liabilities, okay? This is, we could be talking about assets in pre-tax accounts like IRAs and 401ks. This is all taxed to ordinary income. So somebody says like, I got $1 million in an IRA and I'm going to pass it to my kids. Well, that $1 million is not really $1 million. And what happens a lot of times with the do-it-yourselfers or somebody honestly who is acting emotionally and not with any sort of information is a lot of times the kid receives it. They haven't done any tax mitigation up to that point. Kid receives it. I got $1 million in an IRA, and I'm like, man, brother, I can't wait to get it. They withdraw all $1 million of that dollars, not realizing they just shoved themselves way up into the top tax bracket if they weren't there already, and now they got half of that money is gone to taxes. And so now I'm left with $500,000 instead of $1 million of dollars into me. And I just screwed up a whole bunch of my tax bill potentially going forward. And so there's a lot that gets affected here. And especially if you're older years receiving an inheritance, this screws up your Medicare, your Social Security. And I've seen this before where all of a sudden, like that second marriage, they're ticked off that you just screwed up their Medicare and Social Security payments. And so they're demanding that because you took that inheritance and cash it out all at once, that they pay for their makeup on the Social Security and Medicare. And so there's a lot of guilt. So you didn't just get it halved by taxes. You just got a portion of it taken away to pay this other person back, which is your second spouse. So this can screw things up. Okay. We can get into capital gains or estate tax issues or generation skipping tax, transfer tax risk. And what that means is there are tools that we can utilize and leverage that I can skip to my grandchildren and have a ton of growth go into my estate that gets bypassed altogether for my grandchildren. And so they don't get taxed on it. So this is a really big deal. So taxes and hidden liabilities end up being a massive deal. And I'll tell you, this is a big one here, especially if you own a business and you're passing down a business, because right now, not just IRA assets, which is ordinary income, but if we have a taxable estate at the federal level, and in Texas, we don't have any state estate taxes, not true in other states like Alabama and Delaware. It actually has estate and inheritance taxes, which blows my mind. Okay. But if you have a taxable estate, meaning you're above 15 million or basically 30 million filing jointly, everything above that is taxed at a 40% rate. Okay. So if you have a business, we had a situation where we had somebody come in, they were about 32 million filing single. Business was about 20 million. The rest was in real estate and a little bit in brokerage money. That meant that if they died that day, that 40% tax rate was going to kill the real estate or the business. So that was one of our questions is, okay, so what are you planning to liquidate? Because you don't have money to go leverage and borrow in this situation to pay the tax bill. Who's selling the business and who's selling the real estate? And so all of a sudden they were kind of hit. They're like, man, the business is my baby. Holy cow. So we got to go fix those things. So taxes and hidden liabilities. Number 3 is lawsuits and poor structuring. So in inheritance, when we leave things to our kids, a lot of times they're not properties. It might be a rental property. It's not in an LLC. So we got a ton of personal liability, meaning if the renter in that property slips and falls and breaks their leg or has a party and something bad happens, you get sued because you're the owner of the property. If it's in your personal name, they can't just take the property now past insurance, assuming you got plenty. They could take the bank, the cash in your bank account, investments in your brokerage account, and potentially other properties if those are in your name too. So that ends up being a big problem. So 3 biggest threats of inheritance: probate, poor titling, taxes and hidden liabilities, and 3 lawsuits and poor structuring. Okay. And so here's what I want to give you. I want to just talk about just a few solutions that you start considering as you're trying to plan for inheritance. Okay. One is LLC and trust planning, entity and trust planning. Okay. And so let's just talk about, like, if I got rental properties, I want to separate that liability from me. So if I do get sued on a rental property, the max that I could lose is that rental property and nothing else. Okay. And so maybe we need to title that into an LLC. And maybe we need to funnel the ownership of that LLC into our revocable living trust or to our trust planning or estate plan that we've prepared. Okay. And so those are some elements that we can start adding into place. Not perfect for everybody, but those are elements we want to get some asset protection and some planning for our estate to make sure it bypasses probate and it goes to who we want it to go to. Okay. Tax planning with IRAs. So we could be looking, sometimes we get people to hear that, like, man, I don't want my IRA, or I don't need my 401k. I'm just going to leave it to my kids. Well, okay, you're going to drop them with a big tax bill potentially all of a sudden. So we could be looking at transferring that liability or taking tax liability today and maybe do some Roth conversions or some other things. We've even had life insurance leverages that we've been able to use to take like a $3 million IRA that was going to be dwindled down from taxable estate plus ordinary income tax. So there's double taxation there. You could take a $3 million IRA that's going to be dwindled down to 1.1 million. We had in one case. Instead, we were able to leverage that into a second to die life insurance policy that paid them 11 million. And so totally different deal where now you're changing the structure of your estate just by leveraging some different tools that are out there. Okay. So tax planning is a big deal. So we can do a lot right there. Number 3 is business succession planning. Okay. We got to be able to define roles, buy-sell agreements, valuations of the business. You might be able to get marketability discounts depending on how your business is structured. If it's closely held and you know your kids are going to take it over, we might be able to get a reduction in the price of it just because we want to get some asset protection to make sure it passed down to kids. We can reduce the cost of that or the fair market value of that so it doesn't get included into your estate and drive up the tax bill even more. Okay. So there's a lot to this. And when I say, and we even talk about business succession plan, and we can replace that with land. We got a lot of people here in Texas that have, 15,000 acres or giant pieces of land that are awesome. And so they might be land rich, but cash poor. And in those situations, they might not have enough. If it's a taxable estate, that they have to cover the taxes. There's no liquidity to be able to do that. Or another issue is maybe they do. And I know that Johnny's going to take over the land. He's the one who's going to run that. But, Susie doesn't want anything to do with it. And so maybe we got to look at some sort of estate equalization because we don't want to sell the land, but we want value to get split between the two of them. So it's not always cut and dry, but that's a conversation that we got to work through. And then you got to do regular reviews on that because things change throughout the years. People pass away, people get older, right? They come into complex situations. Maybe your kids have had multiple marriages now, or somebody entered the picture that maybe they shouldn't have entered the picture and that you don't trust. There are manipulative spouse situations that we run into, right? And we got to make sure the provisions that have to be added into the plan. So solutions to just consider for those, okay? LLCs, trust planning, which is entity planning, tax planning, business succession planning, and then of course you got to review because a lot of people, we come in and they have 15-year-old estate plans, and then banks aren't going to take your powers of attorney if they're past 3 or 5 years, and some of them even 1 year. So there's a lot of moving factors when it comes to this, but I want to make sure that you guys know it can be different from everybody. So don't take one piece of this section and think it might fit you. Go explore it. Go talk to a professional and see what works for you. Okay. Most people think having a will is enough. It's not. Inheritance, it gets lost in courts, gets lost in taxes and lawsuits every day. If you're not intentional about the structure, it leaves. Money just has a way of leaving. Okay. So structure determines success. So if you guys have some issues, we'd love to help you out. Visit with your professional, whoever that is, your financial professional, your financial advisor, your estate planning attorney, your tax advisor. Get with your team, or if you don't have one, make one, okay? Get with your team and make sure you're walking through the plan that you need to have. If you guys need some help, man, schedule a goals call at Pro Capital. We'd love to be a part of that and partner with you. And if you have any questions, shoot us a message. We're happy to help. Guys, next time, Wisdom and Wealth. We'll see you later.